Morning, stock investors, stock traders. It is Monday, December 15th, and we're starting a fresh week. I think Friday was a doozy of a day. If you're a semiconductor investor, it was a pretty rough day. Broadcom was down 11.4%, and a lot of other semiconductor stocks and semiconductor related stocks were really sold off with investor concerns that, hey, this data center build out, just don't believe it's going to last 3 years, like the forecast would lead us to believe. So it sold off, even though Broadcom announced really good earnings. Their earnings were good. Nothing wrong with their earnings. It's just the investing community was not believing like 2 years from now, companies are still going to be spending the amount that they're spending on semiconductors. And I could understand that thought. I'm actually in the camp of it's not supposed to be a boom cycle forever. Semiconductor is cyclical. It has really nice rises, and then everybody has all the semiconductors they need. They pause for a while, and then they come back, I don't know, a year, 2 years later, and then they begin to buy again. And we've been in this boom cycle for, let's call it 2.5, 3 years. And at some point, these companies are like, okay, we have enough. And you're seeing some signals that are communicating that. Meta signal that, hey, we're going to stop spending, or we're going to slow our spending in that data center. And that caused a big sell-off in semiconductor at that time, and it created a rally in Meta. Okay, so I think we're going to continue to see other stories where, hey, we're not going to keep spending like, our lives depend on it, because they may, but they may not. And if you overspend, you're going to really cripple your company. So we'll see what happens there.
The semiconductor index was the worst performing last week. It was down 3.58%.
Makes sense.
Yeah.
If I zoom out to the 1 week, you see that, yeah, the sell-off was pretty drastic in Nvidia and Broadcom. Google sold off quite a bit. Meta sold off. Uber sold off a lot. Interesting. But you see all this green. This is encouraging to me. You're seeing green in financials. Visa really caught a nice bid. And other areas like consumer discretionary, nice and green. United Health doing well. Industrials did well, with aerospace probably leading the pack. Consumer staples did okay, and materials did well. So zooming out a little bit shows that the rotation may be in process. Let's go 1 month. So when we go the 1 month, we're still seeing green on financials. Now we're seeing, Google was in their appreciation cycle. This space is red, so it's good to see we're rotating out of some of those tech stocks. Utilities, man, they got beat up over the last 30 days. So that's looking good. And from there, I don't know that it will get much out of the 3 month, but let's do it anyway. Look at Apple, 21% over the 3 months.
Yeah, they've been getting it done.
Yeah. And AMD, look at that bid. Look at Micron, 60%. Incredible. Intel, 53%. And those are signs to me that this market's overheated, is when you see these stocks. Micron has two big competitors. They don't have like exclusive proprietary technology that everybody needs, and they have to get it from Micron. No, they can get it from Samsung. They can get it from another competitor. They do storage, and yeah, their storage is good, but you have other players that can come in and sell the same stuff. And Intel, man, that's been a dumpster fire. It's caught a bid for other stories. The government's going to own a piece of them. But look at over here, healthcare. Go Lilly, J&J, Merck. Merck's been coming up a lot on live streams.
Yes, I've been hearing some pretty good things about them.
I think investors smell profits. They're like, hey, let's talk about Merck. Diagnostics and research looking nice and green. Biotech looking good, looking real good. Walmart, man, blue light special 13.69. Incredible. AppLovin, nicely done. And you see this semiconductor space, it's just such a boom. Cisco's doing well, and Google had its nice run. So we're seeing that, there is a rotation developing, but it's still like, geez, look at the 6 month. You're still seeing massive gains here. And Google's up 74%. Nice. So we'll see how that rotation continues, or if investors are like, here's my chance. Now I can buy lots of NVIDIA, or I can buy lots of Broadcom, or you name the stock that was sold off. That may be the case. Investors will do what they think is best for their portfolios. Looks like Kurt's on. Good to see you, Kurt. Or I announced a $2.50 share special dividend, January 2nd, 2026. Wow, nice. And ORI, what is ORI? Old Republic. Insurance, yeah. Look at that. So it's going to enhance the dividend. I mean, it's officially going to be in 2026, but it's not going to be this is the ordinary dividend, and they're going to have a special dividend. So dividend, or stockholders were expecting a nice $1.16 dividend, and now they're going to get another $2.50 per share. Nice. Start off the year with a few bucks in your pocket. Not bad. Excellent. Thanks, Kurt. Good to see you. All right. So we had a couple of things we wanted to open up with, and we can take a look at some stocks. So we looked at the heat map, and the market is going towards a positive open. Looks like it's going to recover some of the losses from Friday early in trading. We'll see if it keeps those gains. I'm always kind of looking for the head fake. Is the market going to open higher and then maybe sell off later? So we'll see. We're stock investors. We're not predictors of the future, but we will see. I know Daryl's got some really good economic data. And John Rogers, thanks for tuning in. I appreciate the nice comment. I hope your week is off on the right foot. And Daryl, you want to share some of the economic data that looked really interesting and kind of gives us some food for thought as we set up our investing plans for 2026 and the rest of 2025.
Yeah, so I've been talking for the last 2 weeks how early December tends to be a little choppy as far as returns go, and this is mostly related to mutual funds having to make adjustments to their portfolio to distribute capital gains to their investors for year end. And I think we've kind of followed this pattern. But the 15th, which just so happens to be today, the 15th day of the month, is when most of that effort is completed. And we tend to get higher stock prices towards the end of the month. This is from the Carson Group, Ryan Dietrich. He's a pretty heavy historian of data related to the stock market. And this is on average from 1950 to 2024. So if we go to a seasonality and just look at 1 year, we can see that we're down 0.2% so far this December. Last year, we actually had a down year. We were down 2.4% last year. The year before, however, we were up 4.6, so this is 2023. We look at 2022, we were down 5.8%. That was pretty much a cyclical bear market.
Mm-hmm.
And then the 2021, we were up looks like 4.6%. We were up 3.7 in 2020, 2019, 2.9, 2018, we were down 8.8. So it's not every year, but on average, we're typically up 1.4% by the end of the year after the 15th, which starts today. So that gives you a little background. It's never perfect, but on average, that's where we sit.
Yeah, we may be setting up for a nice rally toward the end of December.
Yep.
You know, it's low stock prices tend to be attractive.
Yep.
So you may have, pretty good, mood to invest in stocks. And I'm not seeing anything in 2026 that is causing me to think, man, it's going to be a rough year. No, I think it's going to be a decent year for appreciation of stock prices. And economically, I think we're fine, lower interest rates. So, and what I imagine may be the case is that it may not be the same stocks that are the big winners in 2026. It may be a new list of names that are really, setting new highs. So that's what I'm interested in trying to figure out is where is the money going to be made in 2026? And as you guys know, I try to find some good rough diamonds, and then I polish them up and put them in my portfolio. Anything else on these charts?
Do you want to take a look at FactSet
Yeah,
data?
that'd be cool. Yeah, that would look really
And
good.
I'm going to do one other public service announcement real quick. So anybody that uses stock analysis, I've been waiting for this, but they finally released an iPhone and an iPad app. I got them installed today, and they look pretty good at first glance. So if you're a stock analysis user and are in the Apple ecosystem, that's available to you. So let's go to FactSet. So this report was released to the public on Friday, the 12th. I had seen a preview of it on Wednesday, and we talked about it in Friday morning's show, what I recalled from memory. And now the report has been updated and finally released to the public. And this is available for anyone who's interested at factset.com/insight. And John Butters is their one of their chief analysts that does all of this bottom up calculations for the S&P 500. I think S&P Global also does this. Some people prefer that over FactSet, but a lot of people use FactSet as well. So let's first look at the bottom up price target. So this is looking at all the analysts, every single analyst or every stock that has at least 3 analysts or more. It's their price target versus the closing price of the stock as the S&P 500 as of Thursday, the Thursday close. So this 6901 is the Thursday close. And based on the S&P constituents bottom up price target from all the analysts, the target for year-end close would be 79.68. And I'm starting to see other calls for what the year-end targets. Those are always kind of interesting to look at, and usually sometime here in the next few weeks, you'll find a summary from somebody that shows all the price targets of some of the major players. So those are kind of interesting to look at. This is just one input based on a whole bunch of analysts' targets. So we have a target of 79.68 for next year, and 2025 isn't closed yet, but the target at the start of the year was 6,700, and we're actually sitting at 6,901 as of Thursday. So we'll know here in a couple weeks how close they were to this target. And then you can find a couple of years. Most of the time, it looks like they underestimate, but when they or overestimate, underestimate, but when they overestimate big. So 2022, the S&P closing price was a lot less than what they expected it. So that really pulls the average down. We also see in 2016, it came in less than what they estimated. 2018 came in less than what it estimated
And
in
you know what's
2022.
interesting is 2020. Let's look at that year. That they set up like, hey, here are the targets,
Mm-hmm.
and that's before they knew we were going to have this massive pandemic.
Yep.
Even with the pandemic, the market still traded higher than what was predicted before they even knew a pandemic was going to be in the cards. And that showed that was a weird. I mean, if you look at the data, it's a little unbelievable that the market crashed so fast and recovered just as fast.
Yep. Yep. That was the year that I started managing my own portfolio. I retired at the end of 2020.
Okay. Yeah, the scariness there, right, is what's good about like experiencing stuff like that, because I still remember, let's go back to the dot-com bubble. That one was discouraging, right? Because I thought, man, these businesses seem to be really good, and man, they're crashing. And that one took a long time to come back. So that one was kind of a discouraging one. But moving to other events, for example, 9/11, the market sold off quite harshly. I actually put more money in. It was kind of a do the opposite to what all the fraidy cats are doing. That was a really good decision. So then fast forward to 2007, 8, 9. Markets were in a lot of trouble. I mean, these were really big issues with was it Lehman Brothers went bankrupt, and Bear Stearns no longer existed. These were big, and AIG was in trouble. I put more money in, a lot more money, and I was fortunate during that time, 2008, 2009, that I was doing well with my business, and so I put a lot more money, and I put money into real estate. I, took it as an opportunity where when you have these crashes, everybody, or I should say, the media, they make money when they get eyeballs to watch what they're showing and listen to what they're saying. So they don't make money from telling me what I should invest in. So I poured a lot of money into the market in 2008, 2009, 2010, and I poured money into real estate. That was the best move I've made in my career. And those I'm still making money, and that's 15 years later. Great. So when you have these crashes, like, you know, let's not like mislabel it. It's opportunity. It's opportunity for those who are paying attention, doing their homework, having the internal fortitude to invest. But it's not time to listen to the messages that are just going to be emotional in nature, that, oh my God, how far and how ugly and how scary. No, think about, how good is this business? How good is Google? Man, I think they're going to be terrific for the next 10 years. I'm looking at their financials. I don't think whatever economic issue we're dealing with is going to impact them. I'm buying Google. If you want to give me a discount, I'll buy it. I'll buy Meta. I'll buy Robinhood. I'll buy these stocks that I really want to own. Anyway, jumping off point, I thought the data was interesting on 2020. Carry on, sir.
Yeah, I think it's important if we have investors that have never read books about um, behaviors in investing, that would be a good thing to be reading, because our brains are built to protect ourselves. Our limbic system is, built to run from fear. And if we don't understand and control that basic emotion that we have, then it leads people to jump out and sell at the lows during the great financial crisis or the 2022 downturn. So it's really important to understand those behaviors and control them in our mind, and not let our emotions dictate our investing, because they'll usually get us in trouble. So anyway, very good points, Victor, on that particular topic, and it takes a lot of discipline to do that.
And I don't know what sports you guys have played, but I played baseball as a youngster. And, you can read a book on how to hit a baseball, but once you get behind the plate, and I got up to playing high school baseball, so I didn't play beyond that. It's even harder if you think about major league pitching. It's hard. And when you see a ball coming at you, I was in high school, so maybe at 80, 85 miles an hour, but in major leagues, it's 95, and it's a curveball. You got to pick up the spin and be able to hang in there. Put your immediate reflection or your reaction to move away from the pitch. No, you have to hang in there and wait for it to curve, and then you hit it, right? Stock investing. Market sell off, and just be honest with yourself, right? Like Friday, you have a massive sell off in Broadcom, and that's that curveball coming straight at you. Now, if you move back, you're done, because if it curves into the strike zone, you could strike out. So you just have to hang in there and, okay, analyze Broadcom. Is it a buy? Analyze NVIDIA. What didn't change Friday was, did NVIDIA not sell any more semiconductors? No, they still sold a bunch. They're going to sell a bunch to China. So the fundamentals did not change on Friday, but the prices did. So hang in there. When it gets scary, you just have to have the internal fortitude, practice, practice, practice. The art of investing is being able to weather these events, and almost like when it gets really scary and we have sell-offs, turn off the media. I would say lower the number of inputs from outside your own research. I would greatly appreciate if you continue to listen to our streams, because we're not going to pump this things up. We're just going to share research. But I would say, I would encourage you to turn things. That's what I do. As soon as things get really rough, I turn things off, and I only limit, sources that I really, really think are going to help me, not discourage me or scare me. So it looks like, keep going. Did you have any more to share there?
Well, I want to look at this one because I mentioned this one on Friday, but I didn't have the data in hand. I had only seen a preview of this on Wednesday. And Thursday really changed the complexion of this. If I remember correctly, and I'd have to go back and watch the video where I saw this, but materials was actually in second place on Wednesday.
Mm-hmm.
But the price changes in the rotation that started on Thursday and continued through Friday, shifted it down to fourth place. Infotech is still in first place for next year. This is based on bottom-up price chart targets versus the close on Thursday. The real
Daryl,
estate, yep,
I'm in the process of creating a best and worst video for materials.
yep,
And, part of it is, I heard you speak of materials, and then I went in and kind of a little bit of a spoiler alert for my video that's coming out today or tomorrow for advanced members is some of these material stocks are killing it, up 100% a year, up like, I mean, the averages they're up 30% in 2025. And you look at their businesses, they look really good for some of them look really good for 2026. You think about gold miners, they're a
yep.
material stock, but you think about copper producers, we're not like slowing down our consumption of copper. Man, we're buying EVs and building data centers and all kinds of consumption of copper. So, material stocks are kind of not a sexy sector. Technology is the big sexy tech sector, but they've been killing it this year. Back to you, sir.
So then I'd like to mention that healthcare and financials is at the bottom because financials has already had a pretty good run so far. So the gap between their target prices and the closing prices is a lot lower. Healthcare, despite some underperformance in some areas, has actually overall done pretty well the last 3 months. So they're towards the bottom of the list. And energy this year, 2025, I think was losing. The prices are below the
Yeah.
targets. Now, I think this is the only one that was negative. So you can see where the S&P 500 is and which sectors are expected to outperform that for next year.
Yeah. And Paul brings up a good question, which is, I'm expecting a rotation into healthcare. And, this data is interesting to read. Um, and I'm going to kind of restudy my healthcare research on some stocks. It has been, healthcare tends to work when technology and other sectors are struggling because it has growth, it has profits and so forth. And when money leaves tech, a lot of it ends up in healthcare. But I'm going to restudy like my research and just kind of see where I think healthcare is going to end up.
So let's look at healthcare to see if we can't answer Paul's question. So looking over just the last 6 months, healthcare is already up 14%. So if you think about what's going on in that chart I was just showing, unless analysts have upped the price targets, as the price of that particular sector moves up, the gap between the price and the target is lower. So that's going to shift healthcare down the list a little bit. Because
Mhm.
we've already had a really good run over the last 6 months. I mean, it's technology is 21, discretionary is 15, healthcare is sitting right under it. So that's why
Mhm.
it's shifted down to the lower end of the chart. There probably still is a rotation, but some of the gains have already happened over the last 6 months. Hopefully that answers your question, Paul.
Yeah, and I think we should keep asking that question, which is, what sector is going to perform well in 2026? Like every month, that should be a good, solid question because things will change. Like our expectations will change, especially if like the government funds the subsidy on healthcare. That's going to help, a part of healthcare.
Yeah.
And if we hear, some other stories that impact the market, I think it could change the pecking order that was shared a little earlier.
For Paul, here's another example. So real estate was the second highest, just under tech. And the reason it's probably so high is it underperformed.
Mm-hmm.
So the gap between the target and how it actually performed at the close on Thursday, this is why it's moved up into second place. So anyway, just that helps put things in perspective on how those sectors end up where they do in that chart.
Perfect. Good time of the year to be looking at the data and kind of understanding what we think is going to happen in 2026. I thought, looking back, and if we were talking at the end of 2024, I'd probably be thinking, okay, 2 really good years. I'm not all that um, I'm not all that confident that 2025 is going to be a really good year. And the first 6 months was kind of rough, right?
Yeah.
You had that big scare of the whole tariff issue, because if you look at the S&P, it's up 16.46% year to date. Very good rate of return. Excellent. And my thought a year ago is, hey, I don't know that we're going to have 3 consecutive years of an up market. I mean, Santa Claus he's delivered on a few occasions for me, but I don't know that he's going to deliver 3 years in a row. But actually, we did. Over the 1 year, it's 12.77 year to date. The first 6 months, June 30th. Let's see here, June 30th. We were up 5.5, which is decent, excuse me. And considering that we had this big sell-off, and that sell-off took us down pretty hard. But then after that point, again, back to that little pep talk about when these markets sell off like this, let's not get into the fear spiral. Let's get into the analytical empowerment and kind of find those stocks that we could buy, because buying here was awesome. And the year's been good. So if you had asked me a year ago, what's going to happen in 2025, be like, well, I think we're going to have modest gains. I don't know, 5-10% higher. And we're at 16.46. Now, looking at 2026, I'm thinking 10 to 15% gains is what I'm expecting. What are you thinking? What's your just high level? What do you think is going to happen next year
for the S&P?
Yeah,
I think we'll be up overall. I think it's going to be kind of like this year where we had a lot of volatility. I think we'll still have a lot of volatility and rotation, but overall, I'm expecting 2026 to end up pretty well, but not without anxiety along the way.
Well, I call it excitement.
Yeah.
Yeah. And, again, what is important, like the retail investor, the other story that I would want to tell in 2025, most definitely, like you started managing your own money, I guess, coming up on 5 years ago.
Mm-hmm.
And, very good. In a lot of ways, the financial industry doesn't necessarily like they put enough fear out there that, hey, if you do it yourself, you're going to make mistakes. You should come to a professional, pay a professional to make mistakes for you.
Yep, exactly.
Then you can pay a professional to make mistakes for you and underperform the market and charge you 1 to 2%. But at least you'll know that you didn't make the mistake. And the way that I interpret that is, how am I going to get better at investing if I'm not the investor? how do I live through the dot-com bubble as an investor and then try to process the situation and take advantage of it. In 2008, 2009, 2010, I processed the situation, took advantage of it. I bought 5 real estate properties in 2010, 11, 12. And a lot of the people educated that I associate with were like, "Whoa, are you crazy? Don't you see what's going on?" And I'm like, "Yeah, I see exactly what's going on. It's an awesome opportunity to buy real estate. I don't think I'm ever going to see this again." And these properties went up really fast. And I should say, first couple years was kind of a slow upward trend. And then after that, they just started to go up and they haven't stopped going up. So, as we look at, or I should say, back to the retail investor, the population of retail investors is growing because the access to good information, access to good videos, communities on YouTube and so forth, the genie is out of the bottle. Robinhood is flourishing. And for the finance industry to put the genie back in the bottle is going to be impossible. The whole mentality of trust a professional to manage your money. I'm sure there's lots of people that are out there that probably get value from that. I don't want to take away from that. If it's a decision between should I save money or not save money, it's always save up, save money, save a percentage of your income, save for rainy days, save for your retirement. Just have money so you know, make it, you get to a point in your life where you need the money or you want to buy something for yourself, you got it. But if you're actively involved in your investments, you're going to keep learning. You're going to become better and you're going to be better in 26 because of the experiences that you had in 2025. And that's, I got together with, I have a brother that lives up in Chico, California. I'm in Southern California. He's in Northern California. And we got together and I was very happy to see him and we were hanging out and, I talked to him about how, he's more of a passive investor, but how I really enjoy figuring out companies and how, if I pick more winners and losers, it's really fun and I get to make a lot of money. So it's like, cool. It's like a double bonus and it just keeps building. I keep building momentum into the process, keep getting better. And it's not a thing where you age out. Charlie Munger was 99. He could still hit the curve ball, in investing. He still knew what was going on. So he's a great example to use as a North Star. All right. So
Let me show my screen one more time before we go away because I want to point out a video I did yesterday. So
okay.
you saw that real estate was second in the list, just under infotech. Yesterday, I did this video on chart reviews of 14 different holdings that I have in my portfolio. 2 of them are REITs. So if you want to get my thinking about at least a couple REITs that I expect to perform well next year, this video may provide some insight on that. So I just wanted to share that real quick
Yeah.
before we moved away from.
And I like real estate in 2026,
Yep.
REITs, real estate investment trust. And the reason I like them is, we had 3 years of, a very good market. And, if you can buy a REIT, maybe goes up in price 5-10%, pays you 3 to 5%. It's a pretty solid move to diversify. If you're a young investor, first, I don't recommend REITs for anybody that's younger than 35. I don't suggest it. But let's say you're 45 and you're like, hey, killing it over here in tech. I'm killing it over here in communication services. But I'm feeling like if I stay at the party a little too long, I'm going to eat some bad sushi. And I'd like to diversify. And REITs are a really good place to start parking some money and stuff that's going to be safer and it's going to be looking great when things correct. It's going to be like, whoa, REITs are going up when everything else is getting smashed down. So think about like REITs for a diversification play. And also, if you're an older investor, you're 55, you want to retire early. Cool. Awesome. You're like, well, where am I going to get some income? Well, REITs provide awesome income. They provide excellent income. And it's very consistent. They have to pay a percentage of their profits or funds from operations in the dividends. So get to know REITs. They're a good idea. And of course, if you're in REITs, you're in real estate. I also invest in real estate, residential real estate, and hasn't been a good place for me to put capital to work for the last 10 years. It's just been so darn competitive, man. You got to buy properties at really high prices in California. They might be different in other parts of the country or the world. All right, let's take a peek at the market because I kind of commented a little earlier that, I got to be careful with this head fake. The market will head fake me. And look at this head fake. Opened up nice and high. And then it's, since then it's down a portion of that. So my barometer, because Friday was a little bit of a, hey, everybody pay attention. Stock prices do matter. Valuations do matter. It looks like Broadcom's still selling off. NVIDIA is going up in price. Looks like the software space, good opportunity. I'll be buying some Salesforce. I better open up my brokerage account because I don't want this to go away. I'm buying into these two stocks. I'm a believer that these two are on their way higher. Their earnings were good. Investors were buying into them. Today's kind of a day when they're down, when they've been up for the most part. But let's see the rotation here. See, we got financials in the green. That looks good. Consumer discretionary. If we add those stimulus payments in 26, consumer discretionary is going to catch a lot of that money. Retail, people are going to go to Home Depot and buy a little extra. And then we have industrials, aerospace and defense is doing really well. Communication services, Meta's up a little higher. AppLovin, go get it done, AppLovin. That stock's just an awesome company. AppLovin's a lot like Palantir. And if you look at their numbers, just incredible fundamentals. And we've got Staples up a little bit. And look at healthcare. Paul, here it is, buddy. Healthcare is having a good day. Just one day, though. Let's not get carried away. Looks like this is where the money's being made. We saw that over the 6 months. Lilly, J&J, AbbVie, Merck, making a killing. And this is TMO is Thermo. Is that Thermo Fisher? And one day, yeah, looking good. Healthcare is looking good right now. Very nice. All right, so let's get into some stocks. We had a request from a member, and he wanted to look at Ouster. Ouster's been selling off for a couple of days, I guess. It was sold off on Friday. A lot of things sold off on Friday, and it sold off today. Ouster provides LiDAR sensors for automotive, industrial, robotics, and smart infrastructure industries in the Americas. Okay. And it seems that a lot of the car companies are getting into a development cycle where their cars will be self-driving, and they're going to need a lot of this technology. So the demand is probably going to stay there. And of course, robots, right? So if you have a robot that's like, for example, where I live, they're putting these little robots on sidewalks, and they're basically just observing, making sure that if maybe a car is broken down on the side of the road, they inform, hey, maybe a police officer can come and kind of turn on their lights so nobody hits that person that's broken down, that kind of thing. Or maybe if they observe other things, they report it. That little robot needs LiDAR. So a lot of use cases. And I think we're going to see more products like that hit the market. Now, from a growth perspective, they are growing nicely. Revenue is 111 million for the last full year. Trailing 12 months, they're up to 137. Now, this growth rate is not sensational. It's good. And the reason I say it's only good because it's 30% is this is a small company. It's 137 million. It's not 13 billion. If they were 13 billion, it'd be like, hey, that's really good growth. But it's like, hey, you guys are tiny. You have devices, components that should be in demand right now. So I'm a little surprised that they're not making better strides on growth. Gross margins are not fantastic. They're okay. 41%, 41.8, not fantastic. And I'm okay with if they're growing to some extent. I'm okay with it if this line was bigger. If this was like 70%, I'd be like, yeah, don't worry about not being profitable. Someday you will be. But with this level of profitability, I'm kind of seeing this as hey, I'm concerned. You're not growing all that fast. You're tiny. And you're not making a lot of money on the gross margin line. It is growing. Looks like their scale, the size of the company is getting bigger. So they become more efficient at creating their products. So that's good. But they're still losing money, burning cash. Okay. So when we look at their balance sheet, we do not want to see any debt with a company like this. 244 million of cash, only 16 million of debt. Very good. Because a company of this type is burning cash. If you're burning cash and you have debt, it's like, oof, I would run away from this. As if the smoke alarms are going off in a building, get out of the building because pretty soon the structure is going to be engulfed in flames. But that's not the case. They have cash. What's their burn rate on that cash? So they have about $30 million in cash. So they're burning about 32 million. And I think that's going to get better, meaning they're not going to burn as much and they'll eventually be cash positive. So right now they got 6, 7, 8 years of cash on the books that they can use to grow their business. Let's take a look at their forecast. Analysts, 6 of them cover it. They think big discount. They think very highly of the company. All righty. So they're going to keep growing. Growth looks good. They're going to be 400 million in 2028 if things continue to grow. $500 million in revenue in 2029. They'll eventually be profitable in the outer years. So this company is not an investment I would make. And I think LiDAR is an essential kind of piece of technology that's going to be needed. But I don't like the gross margins. They're low. And there is some risk to it because these guys are going to compete against the Chinese, India, Europe. There's a lot of smart people around the world. And I think that for all we know, in 2 years, somebody comes out with a product that's 2 times better and half as much. And that could be a big problem for them. So they haven't seeing growth that is the type that, hey, they went from like 0 to 10 billion very quickly, or even $1 billion, to show me that, hey, the market loves their technology and it's in high demand. It's in good demand, but it's not in great demand. And the stock is bid up. So you see where they came in with a lot of fanfare and they sold off, and now they're really trading higher. But recently, really have sold off from their recent highs. So Ouster would not be an investment I would make. I think there's just way too much risk. There's not enough fundamental uh, value, and I would say the characteristics of this business, the bones, what I like, just to recite, what does great look like? Great in a stock looks like this: very high revenue growth. Customers love the product service, they want to buy lots of it. Very high gross margins of 70, 80%, showing that their idea is really good and it doesn't take a lot to create the product, the physical product. Like example, Meta, they don't have a product. So it's very inexpensive to make the service because it's just advertising. So it's very high margins, high profitability, and free cash flow. If they're small, I'm willing to look the other way on cash flow and net profit, because if their gross margins are there, because that will eventually pay off. And the balance sheet has to be great. No debt, low debt. If it's less than 3 times EBITDA, it's acceptable. If debt is less than 3 times EBITDA, it's acceptable. But if it's above that, then it's risky. So that's what great looks like. And Ouster, their revenue is good. Revenue growth is good, but it's not great. They're tiny. And then everything else is kind of like, undesirable. Balance sheet's okay. So I'll leave this one for other investors to get into. I can find other investments that are small caps that excite me a little more, and I think will be better for me. What do you think of Ouster?
So I do see a fairly lengthy price trend. So this started when it hit the bottom, so it had been on a downtrend, and then it seemed to bottom out here in April of 2023. And I find this uptrend line that's connected to a support there, a support here. It tried to come down and test it, didn't quite reach it. It did reach it in April of this year during the tariff tantrum. So this part looks somewhat positive. You have higher lows over the last 2 years. So then if we bring it into 1 year, I do see a support line besides this trend line. I see one at this gap open here. So that would be sitting about right there, about 1750. I see some support. It did come down and test the 200 and bounced off of it. So that's a good sign. I have this resistance line set way up here at the top, but I could draw several more across there and would be levels that I would be watching. For instance, the support level about right here would be where it bounced off that 200 line and came back up to that resistance and now is turning back over. So that'd probably be a place that I would have drawn it. But I'm going to leave it a little clean right now and just look at these major resistance and major support in this trend line that looks fairly good. I talk about negative bearish divergence on occasion. So here we had a jump up, a gap up. That's where that support line is. It gapped up and the RSI peaked. We went to higher prices and we had a lower RSI. We pulled back slightly and rose up to another peak, had an RSI that was lower. So then before I've talked about when I've shown you these negative divergences, you don't know exactly when it's going to occur, but at some point, you're either going to start trading sideways or you're going to have a pullback. So in this particular case, here we had 3 RSIs that were lower while prices were going higher, and we can see what the result of that pullback was. It was 30%. So when I say at some point it's going to pay the piper, this is what I'm talking about. We just don't always know when. Here we have another one setting up, not quite as drastic because we're trading sideways, but we do have a few higher peaks, and we had negative divergence in play. And, eventually we had another 50% pullback. So that's why I point these out to you. Not that we can predict exactly when it's going to pull back, but when you see this and you see the prices at a peak, it's time to be cautionary. Not a bad place to trim. Not a bad place to sell some covered calls if you own enough of the stock. That's why I point these out. So anyway, this is a good example here.
Excellent. So bear with me. I had my brokerage account open, trading some stocks, trying to take advantage of some of these stock prices that have sold off. And so we're going to get into Path, which is a stock that does software in the AI space. DJ is looking at it. He's saying it's selling off. And the whole software space is selling off harshly. Look at that. ServiceNow, holy smokes. Why is it down 9.6? I think I'm beginning to answer the question, DJ, is you're seeing a lot of stress in this software space. Let's take a look at Path. I like Path a lot because they are a company that created themselves. Look at that. Remember that head fake I was talking about, Daryl?
Mm-hmm.
Be careful with the head fake because the market is still dealing with some fear. So PTSD from Friday. So Friday it sold off quite harshly. Also had a nice volatile day here. And the market's probably still dealing with, man, these prices are expensive. Maybe I should take some of my money and run. Good to see you, Mike. Hopefully you saw most. Yeah, you were for OUST. But the market's giving us a little bit of a head fake today. Well, now we're up a little bit, but it opened much higher. So, all right, so let's get into Path. And Path is a company that provides end-to-end automation platform, range of robotic process automation, RPA solutions primarily in the US, Romania, United Kingdom, Netherlands, and internationally. So the company delivers software robots that emulate human actions with precision and speed for organizations to automate repetitive tasks. Its platforms embed AI, ML, and NLP capabilities to improve decisioning and information processing, allows users to design and combine UI automations. So if AI is going to be a thing, this business is made for the era we're in. That's what I think is a good match. It's like, hey, AI is going to be this big, massive thing. UiPath should be like the most sought after stock in the market. They IPO'd back here and the market sold it off. I stay away from IPOs. Stuff like this happens. Even businesses that I like this one, over the 1 year, it's up 16%. It had a beautiful rise on on earnings announcement, I believe. Earnings, yeah, December 3rd. And they announced, and the stock jumped up. Now it's coming down fast. What's going on? I like Path. I've got a valuation on them. Forward P of 22. Analysts think it's too expensive. If I recall, I think Mike, you told me about Path when they were announcing, or at least you just alerted me, hey, they're going up really fast. And when they announced 16% growth. Not the most amazing growth that I would expect, especially if you're at the center of this AI, as some would call it, industrial revolution. Okay. Well, how come they're only growing by 16%? I like Path. I think 16% is good. It's not great. It's not phenomenal. It's not Palantir. It's not, Apple Oven. It's okay. 16%, and the market wasn't expecting it for a couple quarters. This thing was really slowing down, and they've picked up their growth. Customers are using the Path platform, the UI Path platform. They're liking it. More customers are buying it. Customers are buying more of it. So that's a good sign. So the growth is not incredible, but it's good. What is incredible is their margins. 83% gross margins, profit margins of 48%. There's probably going to be some type of gain there, but that's phenomenal there. Free cash flow could get better. I think it will get better as they get bigger, because they just, they're at this point somewhat small. Probably have to build some things and create, development centers and infrastructure in the data center, because probably a lot of their solutions are fully cloud-based. So all that stuff has to happen. But once they establish scale, I think their cash flow is going to improve and the profits are going to improve. Again, I look at this line to tell me, is the future going to be much better with regards to profits and cash flows? Yes, because of this gross margin. So that looks good. Let's take a look at their balance sheet. Balance sheet, 1.4 billion in cash, only 82 million in debt. Nicely done. You got all the cash you need to keep moving forward. You're already providing positive free cash flow, so you got plenty of cash. Now let's see if they're discounted or not. See, 14 analysts. And I'm going to look at their forecast. Here's their revenue forecast. Okay, we are in this year. They call it fiscal year 26. It ends January 31st, 2026. So we're in the final quarter of fiscal year 2026. They're growing better than that, I believe. And next year, they're supposed to come down to 8.79 and then 8.7. Now, this company has been surprising to the high side, that, hey, we're growing faster than people expected, and that's why the stock really took off. So I'd probably think that they're probably going to grow like 10% next year and the year that follows. They're in the profit phase of their company, and their profits are expanding. Not a whole lot, though. And their PE ratio is pretty reasonable at 21 and 20. So I like a lot of things about their business. High level, I would like them to grow faster. Easier said than done. If they grow faster, everything else is perfect. The gross margins are perfect. The balance sheet's great. Great things will happen. But the growth on the top line is really important. And even Palantir, if you study Palantir's numbers, a couple of years, they weren't growing all that fast. And then all of a sudden, they unleashed growth. It's like phenomenal. They got bigger. I think enough customers use their stuff, and they started to grow really fast. That begins to happen with Path. Man, I will be all over this stock. Right now, as I speak, it offers an 18% discount. That doesn't float my boat because it's a smaller player. It's a smaller cap. What if Google or Amazon or Microsoft, they go, yeah, we got everything that UiPath provides its customers, except we provide it for free. It's like, whoa, that stinks. It stinks for Path. For the customer, the end consumer, they're like, yeah, this is great. I get everything I need that I used to pay Path for free. And that might be why they can't grow all that fast, is that you can get a lot of those AI ML tools from various places. You can get them from Amazon because they have, their AWS cloud services. You can get them from Google. You can get them from Microsoft and so forth. So this one here is a pass for me. And look at that. It updated. Let me hit my refresh here. What's going on? I don't think it had updated the most recent price. I'm still on a pass mode. But let me tell you, if I see the growth in revenue rise, I'd probably want to take advantage of that. And if I saw it sell off even more, I might have to pay attention here. So that's where I'm at with Path. What are you seeing on the charts for UiPath?
I do see a support level here that is tied back to the intraday high or the open on the 30th of May. They came back and tested it on the 30th of September, crossed above it, came down and tested it from the upper side. So it was a support line, resistance line here. Then it broke down below it and it's broken out above it again. So this one's been tested a few times. I think that's a pretty solid support level. I have a resistance level set at this high. It did manage to get above it for just a couple of days and then really started selling off. The slope of this RSI is a bit concerning, and the fact that it's already dropped below the high that we saw right in during this run tells me there may be a little bit more downside here. And it looks like we may be getting a bearish crossover. So I expect this line to at least become a test once more. The 50 line is just barely sitting above that. The 200-day is upward sloping at the moment. It is testing the 21-day EMA today. I'm expecting this one to go lower and probably test the support level.
Yeah, thanks for doing that. And man, I like Path. I think they're doing the right things out there. So Mike, the dividend investor guy, wants to look at, I think, Clorox, right? And what kind of discount do we have out there? Oof, I don't think I have Clorox in here. Let's take a look. And Clorox is a staple company. Consumer staples, household products. $12.4 billion market cap. This year, not a good year. Oof, not a good 5-year. 12.4 billion, revenue 6.77 billion. Forward P is 15.78. Nice dividend at 4.88. And analysts think there's a discount out there. These guys are growing tiny by tiny fraction. Oof, what happened here? That is not good. People are not buying a lot of Clorox products. Interesting. Now, as a consumer, I don't like using Clorox all that much because I don't like the smell of chemicals. So if I was given a choice, I'd probably go with something that's more organic. and maybe a few germs get to me, but I'm afraid of those chemicals. But that's just one consumer speaking. All right, so let's take a look at a couple of things. So we got revenue that's contracting. That's a problem. What the heck's going on? We have positive free cash flow of 636. It has not been growing. Okay. And we got gross margins have been stable. Profit has been growing. That looks good. Free cash flow looks okay. This business is worth, I would say, about 9 to 11 billion minus debt. Let's take a look at debt. And they have about $3 billion of debt. Debt to EBITDA at 2.24. So this business just doesn't have a lot of meat on the bone. The cash flows are not very high, so not going to drive a big valuation. They have some debt that's going to decrement. I'll call it proprietary. I don't like the word proprietary. Is my design on valuations is to take away debt. I get to the net present value of free cash flows, and then I deduct the debt. And I wouldn't be able to get to this market cap. I'll probably be short $4 billion. So this would be a sell for me. This dividend can lure some investors in, but I think that this is a long downward trend. And I don't see what's going to change the situation. They're contracting their top line revenue. And this is really concerning. Like, why is revenue contracting so fast? Has the consumer said, yeah, we don't like Clorox anymore? Are there some hazards to using their products? I mean, it's an old school company. It's been around for a long time. So that's where I'm at with Clorox. And what do you think about Clorox?
I had to go back 15 years to find a good place to put an auto support resistance line, and this seems to be a pretty prevalent point. It's currently trading slightly below that value. It looks to be about 109 or so. I do see a couple more lows that happened in 2018 and 2016 that go down to 85. I don't know if it'll get back down to 85 at this point, but it's looking like it's finding a place where it's been supported several times and is much better price than it was at $202 back in 2020. And it has been on a steady decline since that point. Not a bad price for a consumer staples that pays a 4.88% yield on its dividend. It's probably not a bad place to pick it up, but it could go down to 80, 89 or so.
Mm-hmm. Yeah, speaking of dividends, one thing that I would just put it out there, it might be my preference on investing and how I analyze companies, but it might just be an observation that other people might disagree with, that the dividend rate it's just too easy and simple to use it as a metric or a decision point on a stock. And here's a good example, which is Clorox, right? It's been struggling and it's got a pretty attractive dividend rate. So I actually save that toward the end of my analysis. And I want to make sure the business is good, right? Revenue growth and profits and cash flows and balance sheet. And then FYI, if they pay a dividend, like UPS is paying a great dividend, and I'm buying into UPS, but I got there through fundamentally liking the business and then looking at the dividend. Oh, there's a bonus. They pay a dividend. Oh, awesome. But I would be first one to comment that I think it's dangerous to use the dividend as a decision point. I think it's attractive, but that's just an opinion that I put out there.
Yeah, just to put that in perspective, so it's trading at 107, right? Or excuse me, trading at 101. So if it did drop down to that 89, that's $10. If it got down there, it would take you 2 years to recover the dividend. So that's a good point to support what Victor's talking about if you use that as a primary input.
Thank you, sir. So a lot of chatter on Uber. What's going on in Uber land? Why is the stock dropping? Look at that. 10% in the 5-day. What's going on, Uber?
They got
And
some more bad news on the 10th.
what bad news is that?
Amazon is touting the success of their grocery delivery, and they're expanding to 2,300 additional cities.
And that affects Uber?
Yeah, because they have a delivery component as well.
But they do food delivery. They do like, hey, I want a burrito from Chipotle. Amazon's doing grocery. That's competing against Instacart.
Yep, it hit Cart. I thought it hit Uber too. Maybe I'm misspeaking here. Let me look it up real quick.
Yeah, I mean there's some crossover there. I think Uber I think it will be kind of the target of some of these stories. I'm not seeing that come up here, but maybe that is the story that's bringing the stock down.
Yeah, uh, I don't know how directly it applies to Uber, but they were specifically mentioned as being under pressure Wednesday right after that announcement.
Okay. And out of curiosity, is Amazon stock higher? No, all prices are down. Hey, good news. We're delivering fast. Bad news. Everybody's going to lose money. Okay, so Uber. I bought more shares this morning. I kind of opened up my brokerage account and put in a trade for Uber. The market does this to Uber, does this with Uber. It has these sell-offs, and I kind of like it. Yeah, just sell it off, sell it off, sell it off. The underlying business is terrific. Now they get to a very high valuation through what is I would call it a newer business model that is very advantageous to the company. And that's a low capital intensive business. You have Uber growing and putting more cars and drivers in markets. They don't have to buy more cars. The drivers do because they're, in essence, little or entrepreneurs. They're gig workers. They buy a car, lease a car, and then they ride on or drive for Uber. And therefore, that low capital need enables them to grow and grow quite fast. So their growth on a big number, 44 billion, 18% growth is very good for the last full year. But let's take a look at the quarterly, see what's going on. It's even better, 20%. Very good number on a very, very big revenue total. When we look at the other fundamentals, the gross margins are not going to look terrific because they share that revenue with the drivers. So good portion of that goes to the driver. That's what you would expect. Look at that profit margin. Isn't that a beautiful number? It's almost like all profit once they're done. Of course, because they don't have to maintain cars. They don't have to buy cars. They don't have to replace cars. They don't have to insure cars. There's just a lot that they don't have to do. They just have to develop and run the biggest platform on earth for ride hailing, for mobility, and they do delivery of food. So their gross margins are low, but their profit's high. Free cash flow margin is very good, 17.46. And this business can continue to scale up. They just continue to print money. Now, if I had access to a savings account that paid me 17.46%, I would be loading up that savings account. That is a phenomenal rate of return. Their balance sheet's in decent shape. Let's take a look at their forecast. Now, I know Uber quite well. I'm a big Uber shareholder, and the growth is expected to persist. They're going to get up to 91. Now we have the era of robotaxi upon us. It's beginning to get built out. The one in the lead in the US is Waymo. And there is a partnership between Waymo and Uber on a few cities, I think Austin and Atlanta. So if you catch an Uber in those cities, you can opt for Waymo. WeRide is another option for autonomous, and Uber is partnered with them. Looks like they're providing rides in Dubai using WeRide. And I think there's a couple cities now live with WeRide and Uber. And I think that's going to be Uber's play, is if you want autonomous driving, Uber's going to provide a solution using Lucid cars, and they're going to use a platform. I forgot the name of the software provider, but it's Neuro. And what's interesting is a big investor in Neuro is Google. Well, Google owns Waymo. Owns most of Waymo. So it's like, okay, so Google's got their hands in two big autonomous plays. Neuro is just purely a software company. That software would drive the hardware, which would be a Lucid car, an EV, along with all the componentry. So I think Uber has a very good path forward. They're going to continue to be profitable. How big will robotaxi be? I think it's going to be humongous. I think that the way that we move about our communities, our cities, is changing really fast. And if you make it very affordable, you could start making decisions. And I think younger people are doing this. They don't own cars. They don't own automobiles. They're like, I could call an Uber or a Lyft or whatever I need, and it picks me up and takes me from point A to point B. If I want to go out to eat, I just have the food delivered. I mean, there's so many things. If I need something from the store, I just order on Amazon. But if I avoid buying a car, I just avoided, I don't know what an average car costs, but let's say it's $40,000 in the US. And then you pay insurance, I don't know, $1,000, $2,000 a year, gasoline, maintenance. Where do you park it? What if you live in an apartment building or a condominium area where parking is limited? So I think there's a big shift in lifestyle, and frankly, it's better in a lot of ways. That's happening. And I think that the car business, the automotive manufacturing businesses, they're going to have to change, and it's going to be quite disruptive to the big three in the US, in my opinion. I think we're going to see fewer cars being sold in the future because it's just getting so good. And I have to admit, I mean, most of the stuff that we're buying in our household, you look at 25 years ago, it was a ritual, right? Hey, on Saturday we got to get out to Costco and then Target. We had a young family, so we were like buying diapers and everything that happens when you have kids. And nowadays, geez, you don't have to leave the house for anything. I purposely leave the house to leave the house. I want to go stir crazy. But back to Uber, the big theme the market's going to be so big that I'm not thinking, oh, hey, Waymo's going to be successful. It's not like a winner take all situation. I think the market's going to be so big that there's going to be Waymo's going to win, Uber's going to win, Tesla's going to win. There's going to be multiple winners. It's not going to be Tesla's going to own the whole market on the everywhere, right? Like, I guess Tesla's a good example. Tesla came out with their EV. Great job, Tesla. You went to market, you proved that you could do it. Great. Now there's at least 20 choices for an EV here in the United States. You have new EVs from like Lucid or Rivian that are brand new companies, super cool, great. You can buy them from Honda, GM, Ford. You can buy EVs from Volkswagen. They're kind of all over the place. So Tesla did not dominate, and Tesla is not the only EV company in the US market. There's lots of them. I think mobility is going to be that way. And one huge advantage that Uber has, consumers are very comfortable with it. I have the Uber app. I've been using it for years. I land in a city, break out the Uber app. I take Ubers when I travel. I take Ubers when I'm going to a ball game. And I feel that the Uber experience, I don't have young kids, but if I had young kids, I'd be okay with Uber picking them up. So Uber, I think, is going to be fine. And I think if they keep growing, they keep growing their business. And if the market keeps discounting the stock, I'm going to keep buying. This is either the fourth or fifth biggest position in my portfolio. And I'm buying more Uber. Let me pass it over to Daryl. I kind of went long on that one, Daryl. Sorry about that.
That's all right. So we have a trend line that we established in 2023, and it's been able to hold that line several times since that point. During the April sell-off, we did drop below it, but I tend to ignore those few weeks because it was somewhat of a major event. And then we also have this auto support resistance located right around 81. So we'll now go into a year. We can see that they broke below that upper trend line. They came back up and tested it, so it's acting as resistance now. And then on the 10th, there was that news. They dropped 5.51% along with Instacart and a couple other companies. And today they're taking a 3.3% hit. The 50-day is declining and now sitting right at that trend line. So you have a double point of resistance there. The 200-day is still increasing, but we've been trading below that for 3-4 days. The RSI failed to get to the 60 line on this last run higher. And once again, you kind of have that show up in the RSI. We do have a bearish crossover in bearish territory. And the money flow is still bullish at the moment. Accumulation did drop off this past week. Last week we were basically at a 52-week high there. So it better hold this 20 line or this 80 line, or I would be, for me personally, I would be thinking about moving out. Or not all of it, but I would definitely do some trimming if it falls below this line, because it's showing some longer term downward pressure here. It's
Yeah, I
got to
noticed that.
hold this line, in my opinion.
Okay.
I don't know how much lower it could actually go. I mean, it is undervalued, so I don't. But boy, if it doesn't hold that line, I'd be very cautious.
All right, sir. Nice work. Let's move on. Looks like we have our first super chat of the stream. Let's take a look at Brown and Brown, symbol bro. Brown and Brown markets and sells insurance products and services in the United States, Canada, Ireland, United Kingdom, and internationally. It operates through 4 segments: retail, programs, wholesale, brokerage, and services. The retail segment provides property and casualty. Okay. So we're looking at a business similar to Progressive, Allstate, Geico, but you can't buy Geico. Berkshire Hathaway owns all that company. The other company I was thinking of was Chubb. Okay. So we have a $28 billion market cap company, revenue of $5.35 billion. Ford P looks pretty sensible, 18. Pay a small dividend. Year to date, down. 1 year, 21. So you see how this had a really nice rise. And what happened in insurance, so I've noticed insurance, it became a good opportunity. Insurance companies were caught in kind of a era where car prices and asset prices keep going up, right? So they're more expensive to replace. Should they be damaged? Should they be stolen? And so forth. And their pricing wasn't capturing all the costs properly, but they've adjusted their pricing. Let's see if Brown and Brown has caught up and the future looks good, but the market hasn't realized it yet. So we're going to look at a couple of metrics, and I'm going to show my valuation on insurance stocks because I did some analysis, and here's some stocks here, and we're going to put Brown and Brown in here. But you see, I did analysis on Allstate, Progressive, Chubb, and then some smaller players like Palomar and I forgot Fairfield, I think, Old Republic. And what we're going to look for is return on equity and then price to book, and we'll look at valuation as well. Okay, we'll see where Brown and Brown stacks up to see if they are one of the best investments we can make or one of the worst ones. So let's do a valuation. Then we're going to come back and research it or compare it. Excuse me. All right. So let's make some room here for Brown and Brown. I think insurance is a good industry for next year. They get to charge, good money for policies. So long as we don't have like hyperinflation again, where we had car prices, especially, go up so darn fast. And of course, you're always kind of keeping an eye on natural disasters because if you have a big natural disaster, depending on who insures that area, they're going to suffer big losses. They're going to be having to replace a lot of homes and stuff like that, cars and so forth. All right, these guys are a little smaller. I'm not quite sure where to go with the discount rate. For now, I'm going to go 8%. And now let's go get this information. I'm going to do a quick tour. We're going to look for the growth rates on revenue. We're going to look for cash and debt on the balance sheet, earnings per share data, and so forth. All right, let's go grab that, and then we'll update the model. So these guys, 28 billion. Looking at their Trailing 12 months growth, they're growing really well. 17.5, that's really good. That's a really good quarter. So good job. So when did they report? They're going to report January 26th. So that must have been that they reported October 26th. Yeah. And what happened when they reported? So they sold off, huh? They reported that real good number and the market sold them off. Huh. I'm curious. I want to see their investor relations page. I want to look at what they announced. That growth number is really good. Why would the market sell it off? So they're going to acquire this company. I want to read this article. Okay. 28th. So where's their earnings? Recent reports. So company overview. Okay, Brown & Brown announces third quarter 2025 results. Revenues increased 35%. Organic growth 3.5. So that acquisition was most of the growth, okay? So that explains why the market was not overly enthusiastic about their growth. Now, it's really important to know. That's why I wanted to dig is organic growth is the best growth. Organic growth shows your service or product is so good, more customers are coming to buy it. The existing customers are buying more of it. They're willing to pay more for it. You can increase your price, all kinds of good stuff. Growing through acquisition could be good, but in most cases, it's kind of like, hey, you acquired that business. It's not like you earned it. So it really changes my enthusiasm about Brown & Brown. 3.5 organic growth is not overly awesome. Okay, so let's get back. We answered that question. When we look at their overall profitability, so they're growing nicely. Let's take a look at free cash flow. Expanded, looks good. Free cash flow looks really good. Okay, good. All right. And let's take a look at their debt level. I imagine their debt went up because they acquired a business. Yep. So they have net about $7 billion of debt. Debt to EBITDA is 4.18. Now, right now it's forgivable because they just acquired a business, and I think they could pay off some of that debt because they're generating cash. Okay. But it's important for them to manage that debt level because this is above 3, and that is a concern. Okay. So now that I have that, let me take a look at their forecast. So we have 13 analysts covering this stock. They think it's an opportunity. And when we look at their forecast, so we are finishing this year. This is the year they acquired that business. And it looks like they're going to acquire another business because I saw the headline. Okay. And then from there, they're going to be growing at like 6%. They're going to have a contraction year, but it's so far out. This is kind of These guys are kind of guessing, and I'm not going to take that into account. I'm going to expect they're going to grow like at 6%. Okay. So I'm forming kind of like how are they going to grow in the future? That's why I'm kind of looking at these numbers and trying to get a good sense on this business. Let's go ahead and update their valuation. So these guys are going to be a little riskier. They're taking on some debt. They are, so I'm going to increase the discount rate. Taking on some debt. That's probably a good idea. I'm going to grow years 2 through 4 by 6%. So let's take a look at their cash flow. And their cash flow is $1,299,000,000. Okay. And then they had $1,190,000,000, $8,030,000,000 of debt. I don't think my share count is correct. So let me correct the share count. So on cash, the net present value of their free cash flows, we're not getting to the stock price. Let's take a look at the earnings per share. So earnings per share for 2026 is going to be $4.74. 18 is fine. It's expected they're going to grow that by 10%. So I'm going to go 9 just to be more conservative. So Brown & Brown is not overly exciting. And we're in a market of stocks where we get to buy a variety of insurance companies like Old Republic's discounted by 19%, Allstate discounted by 57%, and Zurich Insurance 27, Progressive discounted by 20%. And this is kind of a very well-known company. So if I had to choose between Progressive and Brown, I'd probably go with Progressive because I want a very solid investment that's going to go up in value. And Progressive discounted at 20% is pretty good option. I'm an Allstate investor, by the way. I think that's my best option. So let's take a look at comparing them against some other companies here. And I'm not sure where they're going to land here. So let's just kind of add them and add their ratio. So the PE ratio that we had available on 2026 numbers from Brown & Brown is 17.98. Not the best PE ratio out there. Allstate has that. And then return on equity, and that you can find within statistics within the stock analysis page. And we're going to get return on equity there. So return on equity is 10.7%. And they're not number one there. Progressive is number one. We want the highest number here. We want the lowest number here. And then price to book. So price to book ratio, again, we get it from stock analysis. Price to book ratio 2.22. We want the lowest price to book. And they are not number one there. That would be these guys here. So I don't know where I'd rank this, but they wouldn't be toward the top. It'd probably be toward the bottom because you have these choices. You have these guys that are really low PE. You have these guys that are smaller, that are priced better. And then you have Progressive, which is on the comeback trail. And Progressive has a better PE, a better return on equity. The price to book is a little expensive because it's the most popular stock. It's the biggest cap. So that one there would be a sell for me. I would not buy Brown & Brown. It's too expensive, not competitive with its counterparts in insurance. Let's take a look at the charts with Daryl.
Okay, so this is another good example of a negative divergence on the RSI. And we also have one on the PPO. And once it broke that, that's exactly when the downtrend started and has been going on since April. And the 200-day is now rolling over. So this is a confirmed downtrend at this point. It is moving up slightly today. We do have some resistance at this 50 line, which would be about $83. And then you're going to have some resistance right at this downtrend line once more. And then the next real strong point of resistance that I see is at this gap down. And that's also confirmed by these price by volume bars. So you have a whole bunch of people that bought between 97 and 92. It's trading down now at 82. They be tempted if it gets above this price to start getting out, and that'll start driving the price lower again. So this is definitely going to serve as resistance if it breaks through the 50-day and this downtrend line. So they have some work to do.
Yeah, it looks like they're a big company growing through acquisition. And yeah, it's just the market's selling it off and the valuation's looking a little iffy. But thanks for the super chat, John Rogers. Hope you found the analysis interesting. We're going to scoot over to FLNC. Fluence Energy. Fluence Energy, through its subs, provides energy storage optimization software for renewable and storage applications in the Americas, Asia, Europe, Middle East, and Africa. It sells energy storage products with integrated hardware, software, and digital intelligence. So cool. That looks interesting. So here's a quick view of their website. So these are big batteries. So you have big solar arrays that are just cranking out the power, or maybe the wind turbines are cranking out the power, and then they get stored in these batteries. So probably useful. Data centers, of course, other uses as well. Okay, so the solar space has kind of been under threat, but these guys are doing quite well, especially recently. They've gone from $7 up to $21, tripled in price. Wow. Small cap, $4 billion. Revenue, $2.26 billion. They're not profitable yet. Okay. Analysts think it's getting a little expensive. Stock's been places. It was really expensive. Sold off some more. Now it's beginning to rise. Okay, so so I'm seeing some red. What's going on here? So the most recent quarter, September 30th, they contracted by 15%. They did have a good quarter previous to that. And then negative. Yeah, they have chunky numbers. They might be like project based, like, hey, we delivered a bunch of new batteries to a big giant customer, so we had a lot of revenue on that particular quarter. So that might be going on. But overall, it doesn't look good because when we go trailing 12 months, you're contracting by 16%. Okay, so that's a red flag for me. You're not growing. What gives? So, moving down to gross margins. Gross margins are small because they're making something. They're buying materials. They're creating a product, delivering that product. It takes a lot of, cost of goods sold, material costs, labor to make the product, probably a lot of delivery cost and so forth. And that leaves very little room for profit and so forth. Margins are tight, net profit margin, and free cash flow is negative. Okay, so it's interesting that this stock is moving higher. It might be moving higher on the story that data centers are going to start using their products. That makes sense. I don't see why they wouldn't. And balance sheet's in good shape. They've got excess cash, 284 million. How much cash are they burning? So trailing 12 months, they burned 160 million. So I think they're going to be fine because they're experiencing, a couple years of transition. They got to keep growing. They got to start growing, I should say, and they got to see how they can expand that profit. So they are expected to grow. Is the final quarter where they're expecting to grow? So yeah, this is where the growth is happening. You see that this was contracting, but now it's expected that they're really going to grow. Very good growth expected over the next 4 quarters. They're going to be profitable next year, the year that follows the year we're in, because we're in already fiscal year 2026. They ended fiscal 2025 on September 30th, and they're going to be profitable next year. So there's some pieces to this company that seem interesting, but there's some pieces to it that I look at the gross margin and I'm like, man, I don't know that I want to own this business. 13% gross margins are really small. So I'd have to see one more quarter and then kind of be convinced that their business is going to have a sustainable revenue level, because it may be that they have a nice year and then from there they don't, and then the stock sells off again. So I'd be concerned with that. Right now, I don't have a valuation because I don't have any cash to work with, and I don't have profits to work with. They have a very good story for the next 12 months, which is fiscal year 2026. And if you're an investor based on growth, this thing's going to grow over the next 12 months. So that looks interesting. But that's as far as I could go. It would not be an investment I would make. It's just not enough there. What do you think of Fluence Energy, Daryl?
So I'm looking back over their entire lifetime, and I've set a support resistance line right here that served as resistance, broke above it, broke below it, ran above it here, tested it almost to the penny there in for several months at the end of 2024, and it's about where it's trading at the moment. One of the things I find fascinating here is over this lifetime, most of the buyers bought between 1780 and 1622, but not far behind that. I'm going to put my crosshairs at the upper end of that lower band. Look how the volume picked up in that short duration. So between February and about June, the end of June, look how much volume happened there. So there were a lot of buyers looking to buy this one under 647. And they did a good job of picking up the shares there. And we'll go in a little more here. I'm going to go to 2 years because I'm going to point out a couple things on the 50-day. So we had the 50-day cross below the 200-day. It's referred to as a death cross. And I usually like to wait until the 50-day starts curving back around. That doesn't get you in at the very bottom, but it prevents this where you're thinking it can't go much below 17. There were a lot of buyers there. Keeps going down, gaps down. Well, it can't go much below that. No, it went down to 346. So I like to buy it when the 50 days starts coming back around. You're not going to get the bottom, like I said, but you miss out on all of this down spiral time. We do have a 200-day that has finally, after quite a while, has started turning back upward. The 50-day did cross above that. It traded during this run here above the 21-day almost consistently from September all the way to November. It came down and tested the 50-day moving average, and now is got above that long-term support resistance line, trading slightly below it. We'll see if it can hold the 21-day there. So this seems to be long-term resistance for the time being. For any price rises above that, it needs to get above there and sustain it for at least a week or so. The RSI is declining, and it looks like we're getting ready to have a bearish crossover here shortly.
Thank you, sir. And
yeah, and I also see the RSI peaks are lower, so we have another bearish negative convergence, the divergence there.
Perfect. Thank you. So we have arrived to our last request. That is Snap-on Incorporated. Now, I'm familiar with Snap-on, really respected maker of tools, and a lot of the trades, automotive, aviation, collision, construction. Snap-on tools are excellent quality. And they have a variety of brands. And these guys, their stock over the last 5 years has been a winner. Last 1 year, not so much. So what's been going on for the last year? Is this an opportunity? Pays a dividend payer. This is an industrial stock. The market cap, 18.36 billion, revenue 5.12. Okay. And the revenue growth has been good for a couple of years. The quarters, last quarter looked okay. Looks like they had a couple contracting quarters, flat. Okay. And trailing 12 months, flat revenue growth. So they have very good for an industrial company that puts materials into their products and so forth. Looks like they have a good gross margin, 51.8%. Very good profit margin at 19.83. Very consistent. So the revenue growth isn't there. That is a concern. Profitability is good. Gross margins are okay. And the free cash flow margin is good. They have their free cash flow has kind of been stable, not growing. So that is a little bit of a concern. It's a good business, good company. I'd probably want to pay 20 billion, 20 times their free cash flow minus debt. See if they have any debt. No, they don't. So this business is fairly priced at a small discount, and it pays a dividend. I like the brand. I think very highly of their tools. I don't own any Snap-on tools because I'm not a professional. But I think professionals really, really like Snap-on. And for me, it wouldn't be an investment because I don't think there's enough there for me. I'd rather buy into something that has been sold off quite drastically. I got in within industrials. I bought into UPS. I bought into 3M at the right times, and have done well. Here, if the market sold Snap-on, maybe I would buy it. But right now, it's kind of set. It's set. It's priced correctly. I think I wouldn't be buying it because I don't think I can make a lot of money on it. So those are my comments on it. What do you think of Snap-on?
Okay, so we're looking back 14 and 26, 40 years. Look at this trend channel. Wow. Beauty. Thing of beauty.
Yeah.
So
Snap-on's quality through their product and through their stock. Look at that.
Yep, that's a beautiful thing. So during the great financial crisis, it dropped below that trend channel. During the pandemic, it dropped below that trend channel. So I think that's a pretty good lower side of that. I just made a duplicate. Tried to connect as many tops as I could, so sometimes it trades above the trend channel. It really hasn't done that since 88, 98. But it came down to the bottom of the trend channel and then has been trading pretty well. We had another drop here in 2020. That was to be expected. Pretty much trades right at the middle of that trend channel and has since 2015. So we could measure the slope of this line and kind of predict where the price would be in a few years if we wanted to do that. It looks like it's so consistent that you could probably predict a price 10 years away from now and be pretty doggone close to what the price would actually be.
Yep.
So I'm just going to go down to 1 year. So it is trading really close to its middle of that trend channel. It's been trading above a 5-day moving average, a 21-day, a 50-day. Let's step back maybe. Well, I don't know when somebody'd be interested in buying it. It does get below the middle of the trend channel on occasion. I can see several examples even over the last year or two. So if I were buying it, I would kind of wait for that. Just be patient. I mean, we were just looking at 40 years, so it's not like I have to buy it tomorrow. If you're a long-term investor, just wait for the price to come to you. And that looks like a good price would be right around that dotted line. Anywhere around that dotted line, just buy it and hang on to it.
All right. Thank you, sir. All right. Good work today, Daryl.
Thank you, Victor.
Looks like the market continues to sell off. Broadcom, Apple's being sold off. Boy, the software application space is sold off. I already bought CRM shares this morning, Adobe shares. I got to go back and buy some Intuit shares. What is going on with ServiceNow? Man, that is brutal. So that is interesting. Amazon's selling off. Energy selling off. Looks like some healthcare companies are picking up a nice bid. Okay. Insurance. We talked about insurance. It's going up. Okay. AppLovin's flying high. Good. All right. So that's the market we're dealing with. And right now it is just slightly lower. No big deal. The NASDAQ's down a little bit. Russell's down. So I think we've got some a little fear to process in the market. But we'll see how long we're in this. It could turn around and we start rallying higher. Or better yet, if it's rotating into some new sectors, great. That's good news. It's very good news. Good to be diversified. All right, so we're shutting it down. Anything else you want to add? Anything going on with your channel this week that you wanted to mention?
Not other than the video I talked about at the beginning of the show. If you are interested in REITs, I talk about a couple REITs there, and I really focus on Vici. I think Vici is a great opportunity at the moment, and go through some information about how I think the concerns are overstated related to Vici. But I cover 14 stocks in there, and basically how I use charts to make my trading decisions. So I started sharing those 3 weeks ago, and they seem to get a lot of attention. So hopefully everyone finds those helpful that watches them.
Excellent. Thank you very much on that. So that is it, folks. Thanks for joining our stream. We're going to try to stream on Wednesday morning, same time, and hopefully you'll join us then. And we'll try to stream on Friday. A couple big earnings coming up. Micron's earnings are coming up. And looks like Dwayne grabbed some Amazon. I'm going to think about, I own a lot of Amazon, but I'm going to think about maybe getting some shares today. And so in the evenings, I'm going to try to stream probably tomorrow evening and Thursday. We'll see how things play out. But thanks so much, everybody. Have a good week. Good luck with your investments, and we'll see you on the next one.
Have a good one, everybody.